Debt market update, May 2023. GSEC yields trended lower during the month, primarily driven by robust buying by insurance and banking sector. Sub 5% CPI for April 2023. Likely liquidity improvement for banking sector following the announcement of withdrawal of INR 2000 notes by RBI and potential pause by US Fed in rate hiking cycle. The 10-year GSEC yield ended the month at 6.99%, down 13 basis points after a drop of 19 basis points in the month before. Corporate bond spreads over GSEC inched up slightly compared to last month. Average interbank liquidity surplus declined in May 2023, primarily driven by fall in ways and means advances of central government. FPIs bought debt worth $0.6 billion in May 2023. Cumulatively, FPIs have bought debt worth $1 billion in 5 months CY23, vis-a-vis being net seller of $1.4 billion during the same period last year. On 8 June 2023, RBI's Monetary Policy Committee unanimously decided to keep the policy repo rate unchanged at 6.50%. It also retained the monetary policy stance with majority of 5-1, reiterating that MPC remains focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. Outlook: RBI maintaining the status quo on rates and stance was largely in line with market expectations. However, RBI emphasis on bringing down the headline CPI to its target of 4% and not just within the tolerance band of 2 to 6% was viewed as marginally hawkish. Hence, there was a minor reaction in yields post the policy announcement. The sub 5% inflation print for April 2023 has provided RBI more elbow room to assess the impact of cumulative rate hikes and policy tightening done till now. We continue to believe that RBI's future course of actions will be a lot more dependent on incoming data, and it is not likely to restart rate hikes soon. RBI noted that surplus liquidity has increased in April-May 2023, especially post the withdrawal of INR 2000 banknotes, but it remains unevenly distributed. It has absorbed liquidity to the tune of approximately INR 1.5 trillion in past month. RBI, in our view, is likely to continue using short-term liquidity absorption tools like variable rate reverse repo until clarity emerges on the net liquidity likely to be retained in the banking system after factoring in currency deposits and withdrawals. Since the start of FY24, yields have rallied significantly, primarily driven by strong demand for SLR securities from long-term buyers. The longer end yield rallied more than the shorter end, thus further flattening the curve. Going forward, several factors seem favorably placed for the fixed income markets. CPI has eased from the peak and is likely to ease further in view of softening momentum, lower input price pressure, and correction in global commodity prices. While growth has been resilient, it is likely to moderate, led by slowdown in exports, decline in fiscal impulse, and soft private consumption. External sector is comfortably placed, with current account deficit expected to remain within manageable level, driven by lower oil prices and robust services exports. Further, adequate foreign exchange reserves should keep pressure on INR at bay. Also, RBI is likely to maintain pause for an extended period, and the bar for future rate hikes is high. All the aforesaid factors bode well for the fixed income markets. Key risks to the outlook are elevated core CPI, resilient domestic growth, robust credit demand, and continued global monetary tightening. Rise in geopolitical tensions, oil prices, lower GSEC demand from insurance sector, and increase in issuance of state development loans in FY 23-24 are other important factors which could keep the yields at elevated levels. On an overall basis, in our view, yields are likely to trade in a range with a downward bias. While we continue to recommend investments into short to medium duration debt funds, investors could consider higher allocation to longer duration funds in a staggered manner, in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.